If you're a freelancer or self-employed, you probably know you should be saving for retirement. But here's what most people don't realize. The IRS just increased the contribution limits for 2026. And if you're using the right retirement account, you can now save way more than you think. I'm talking about contribution limits that go as high as $83,000 if you're in your early 60s. Even if you're younger, you can still save $72,000 or more in a single year. That's not a typo. And if you're only putting away $7,500 in an IRA, you're leaving tens of thousands of dollars in tax savings on the table. I'm going to break down every retirement account available to freelancers in 2026: Solo 401k, SEP IRA, Simple IRA, Traditional IRA, and Roth IRA. Show you the exact contribution limits and explain which one lets you save the most based on your age and income. Let's dive in. First, let's talk about the Solo 401k, also called a one-participant 401k. This is the most powerful retirement account for freelancers, and for 2026, the limits just got better. The Solo 401k has two types of contributions: employee deferrals and employer profit-sharing contributions. You're both the employee and the employer, so you can contribute in both capacities. As the employee, you can defer up to $24,100 of your income in 2026. That's up from $23,500 in 2025. This can be traditional pre-tax or Roth after-tax, and you can split it however you want. Then as the employer, you can contribute up to 25% of your net self-employment income as a profit-sharing contribution. For most freelancers, this is calculated as 20% of your net profit after deducting half of your self-employment tax. The total combined limit, employee deferrals plus employer contributions, is $72,000 for 2026 if you're under 50. That's a massive tax deduction if you can max it out. Now here's where it gets even better. If you're 50 or older, you get catch-up contributions. For 2026, the standard catch-up is $8,000. So if you're 50 to 59 or 64 and older, your total limit is $80,000. But if you're between 60 and 63, there's a new super catch-up rule. Instead of $8,000, you can contribute an extra $11,250. That brings your total limit to $83,250. This is a huge opportunity. If you're in your early 60s and you have a profitable year, you can defer over $80,000 and pay almost no federal income tax. That's not tax evasion. That's just using the rules the IRS gives you. Here's an important change for 2026. If you're 50 or older and you had W-2 wages of $150,000 or more in the prior year, your catch-up contributions must be Roth. They can't be traditional pre-tax. This applies if you have a side W-2 job or if you pay yourself W-2 wages from your S-Corp. If your W-2 income hit $150,000 in 2025, your 2026 catch-up has to be Roth, meaning you pay tax on it now, but it grows tax-free. If you don't have W-2 income and you're purely 1099 or Schedule C, this rule doesn't affect you. But if you do, plan accordingly. Let's talk about the SEP IRA. This is the simpler alternative to the Solo 401k. You don't have employee deferrals, only employer contributions. For 2026, you can contribute up to 25% of your net self-employment income, capped at $72,000. For sole proprietors, that's roughly 20% of your net profit after the self-employment tax deduction. The advantage of the SEP IRA is simplicity. You can open one in 5 minutes, there's no annual filing requirement, and contributions are flexible. You don't have to contribute every year. The disadvantage? You can't save as much as a solo 401k unless you're making really high income. If your net profit is $100,000, your SEP contribution is about $20,000. But with a solo 401k, you could contribute $24,500 as the employee plus around $20,000 as the employer, over $44,000 total. So for most freelancers making under $200,000, the solo 401k is better. But if paperwork stresses you out and you want dead simple, SEP IRA works. Now let's cover traditional and Roth IRAs. For 2026, the contribution limit is $7,500, up from $7,000 in 2025. If you're 50 or older, you can add a $100 catch-up for a total of $8,600. Here's the important thing. You can contribute to a traditional or Roth IRA in addition to a solo 401k or SEP IRA, as long as you meet the income limits. For Roth IRAs, the 2026 income phase-out ranges are: single filers starts at $153,000, fully phased out at $168,000. Married filing jointly starts at $242,000, fully phased out at $252,000. If your income is above those limits, you can't contribute directly to a Roth IRA. But you can still do a backdoor Roth conversion, contribute to a traditional IRA, then convert it to Roth. That's a separate strategy I'll cover in another video. For traditional IRAs, there's no income limit to contribute, but the tax deduction phases out if you also have a retirement plan at work or through self-employment. Since most freelancers with a solo 401k are covered by a retirement plan, your traditional IRA contribution might not be deductible. In that case, the Roth IRA or backdoor Roth makes more sense. Let's talk about simple IRAs. These are designed for small businesses with employees, but if you're a solo freelancer with no employees, you probably won't use this. You'd use a solo 401k or SEP instead. But if you do have a simple IRA, maybe through a side gig or because you employ family members, here are the 2026 limits. Employee deferrals, $17,000 or $18,100 for certain enhanced simple plans. Catch-up contributions, age 50 plus, $4,000. Employer match or contribution, typically 2-3% of compensation. Total limit, around $21,000 to $22,000 depending on your match. The simple IRA is less powerful than a solo 401k, but it's easier to administer if you have a few employees and don't want the complexity of a full 401k plan. So, which account should you use? Here's my decision framework. If you're a solo freelancer with no employees, use a solo 401k. It gives you the highest contribution limits, the most flexibility, and the ability to do Roth contributions if you want. The paperwork is minimal until you hit $250,000 in assets, and even then, it's just one form a year. If you hate paperwork and want maximum simplicity, use a SEP IRA. You'll save less than a solo 401k at lower income levels, but it's easier to set up and manage. If you want to save an extra $7,500 to $8,600 per year and you meet the income limits, open a Roth IRA in addition to your solo 401k or SEP. You can do both. If you have employees, consider a simple IRA or a full 401k plan. Don't use a SEP unless you're okay with contributing the same percentage to all employees as you do for yourself. Let me give you some real-world examples so you can see how this plays out. Example 1. Freelance designer, age 35, net profit $80,000. Solo 401k employee deferral, $4,500. Solo 401k employer contribution, $16,000, 20% of net after SE tax. Total. Solo 401k, $40,300. Roth. IRA, $7,800. Total retirement savings for the year, $48,000. That's 60% of gross income going into retirement accounts. It's aggressive, but it's possible if you're living lean and building for the future. Example 2. Freelance consultant, age 55, net profit, $150,000. Solo. 401k employee deferral, $24,500. Solo 401k catch-up, $8,000. Solo 401k employer contribution, $30,000, 20% of net after SE tax. Total solo 401k, $62,500. Roth IRA, $8,600 if income allows. Total retirement savings, $71,100. That's nearly half of gross income going to retirement, and it drops your taxable income significantly. Example 3. Freelancer, age 62, net profit $200,000. Solo 401k employee deferral, $24,300. Solo 401k super catch-up, 60 to 63, $11,250. Solo 401k. Employer contribution, $40,000, 20% of net after SE tax. Total solo 401k, $75,750. If income is below Roth limits, add Roth IRA, $8,600. Total retirement savings, $84,350. You're saving over $75,000 and drastically lowering your tax bill in your peak earning years right before traditional retirement age. Here's what you need to do right now. First, decide which retirement account makes sense for your situation. If you're solo with no employees, it's almost always a solo 401k. Second, calculate how much you can actually afford to contribute. You don't have to max it out. Even $10,000 or $20,000 is better than nothing. The IRS gives you until the tax filing deadline, April 15, 2027, to make 2026 contributions, so you have time. Third, open the account if you don't have one already. Fidelity, Vanguard, Schwab, E-Trade. They all offer solo 401k plans with no account fees. You can do this online in about 20 minutes. Fourth, set up automatic contributions if possible. If your income is consistent, automate monthly transfers. If it's lumpy, make manual contributions quarterly or after big projects. The 2026 contribution limits are higher than ever. If you're a freelancer and you're not taking advantage of these accounts, you're paying way more in taxes than you need to. A solo 401k is the single best tax strategy for self-employed people. And now you know exactly how much you can contribute. If this was helpful, subscribe for more freelancer tax and retirement strategies. Drop a comment with your age and income, and I'll tell you which account and contribution amount makes sense for you. See you in the next one.